Ladies and gentlemen, good day and welcome to the IKIO Technologies Limited Q1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Suyash Samant from Stellar Investor Relation Advisors. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us today. We have with us today the senior management team of IKIO Technologies Limited, Mr. Hardeep Singh, Chairman and Managing Director, Mr. Sanjeev Singh, Full-time Director and CFO, who will represent IKIO Technologies Limited on the call. The management will be sharing the key operating and financial highlights for the quarter ending 2025, followed by a question and answer session. Please, this call may contain some of the forward-looking statements which are completely based upon the company's beliefs, opinions, and expectations. These statements are not a guarantee of the company's future performance and involve unforeseen risks and possibilities. The company also undertakes no obligation to update any forward-looking statements to reflect developments after the statement.
Suyash sir, your voice is breaking a lot.
Okay, is it better now?
Yeah, now it's better, sir.
Okay, so I'll just say the last part again. So these statements are not a guarantee of the company's future performance and involve unforeseen risks and uncertainty. The company also undertakes no obligation to update any forward-looking statement to reflect developments that occur after the statement is made. I now hand over the conference to Mr. Hardeep Singh. Thank you, and over to you, sir.
Yeah. Thank you all for joining the Q1 FY26 earnings call. Our presentation has been uploaded on Stock Exchange. I hope you have had a chance to look at it at glance. In Q1 FY26, we continue to diversify our business mix without impacting overall revenue, achieving a healthy 7% quarter-on-quarter growth to 120 crores. This growth was primarily driven by strong performance in the product display, energy solutions, and other segments, which collectively offset soften observed in the ODM home lighting business. Our strategic transition from single customer ODM home lighting model to a broader diversified customer base across emerging verticals has been started, yielding results. Revenues from other businesses segments grew 35% year-on-year and 10% on quarter to 81 crores, now contributing 68% of the overall top line. As a result, our reliance on a single customer ODM home lighting segment has been significantly reduced from 52% in Q1 FY25 to 32% in Q1 FY26. This shift not only strengthened our revenue mix, but also positioned the company for long-term sustainable growth. Additionally, I would like to highlight that we are expanding our customer base in the lighting segment by onboarding leading Indian and international brands as ODM suppliers. We are also foraying into high-end lighting categories, including indoor, industrial, office, and outdoor applications. Now I will request Mr. Sanjeev Singh to provide his thoughts on the quarter and discuss the financials. Thank you very much.
Thank you. Allow me to take you through the key strategic initiatives undertaken during the quarter to drive growth, along with additional insights into the progress we have made. As previously mentioned, we have successfully entered the Gulf market through exports under our product display segment. The region has shown encouraging traction. with strong growth momentum and profitability achieved within the first year of operations. The RV business in the USA is gaining traction, with other expansion initiatives in the region also progressing well. Overall, revenue from outside India rose to rupees 30 crores, marking a growth of 3% year-on-year and 84% quarter-on-quarter. Revenue from international markets contributed 25% in Q1 FY26, underscoring steady progress in our global expansion strategy. Now coming to our financial performance and the utilization of our IPO proceeds. As highlighted earlier by Hardeep ji, our growth trajectory continued in Q1 FY26, with revenue increasing by 7% quarter-on-quarter to rupees 120 crores. EBITDA for the quarter stood at rupees 11 crores, reflecting a robust quarter-on-quarter growth of 83%. Profit after tax improved to rupees 2 crores in Q1 FY26 compared to a loss of rupees 1 crores in Q4 FY25. Additionally, cash PAT grew by 74% quarter-on-quarter to rupees 9 crores, further reinforcing the operational and financial momentum we are building. On the IPO proceeds, the repayment of debt was completed immediately after the IPO. Block 1 is now operational. For Block 2, civil construction is nearing completion. We have now deployed around 75% of the IPO fund and are on course to complete deploying the rest within the timeline we set for ourselves. In summary, our expansion into new markets play a vital role in diversifying our revenue streams across both products and geographies. We remain optimistic about the long-term value and impact of our strategic initiatives. With this, we conclude the company's presentation. I now request the moderator to kindly open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nilesh Sharma from Anandnath Skykin Private Limited. Please go ahead.
Good afternoon, sir.
Good afternoon.
Good afternoon.
Sir, I want to ask regarding your margin, OPM margin, which are very significantly reducing quarter-on-quarter. As we were the player of two-digit margin, 17%, 20%. Now we are struggling to maintain 10% margin. Can you please give the guidance when we can achieve the good margin and guidance for the next year in terms of top line and bottom line?
Thank you, Mr. Nilesh, for putting up the question. Basically, when it comes to margins, if you look at this quarter or even the preceding quarters, most of the current factors impacting the margins are temporary in nature, in the sense that, as you are aware, that we are in the process of diversifying into new product categories beyond our, ODM home lighting business. As is typical during the initial phase, lower volumes in these new verticals have resulted in higher input costs due to smaller procurement quantities. However, as volumes, ramp up and we achieve scales in these segments, we expect gross margins to gradually return to their historical levels. But this is taking time because, as all the new product lines and categories, you have to achieve a certain level of quantities in order to gain efficiencies in terms of your buying and in terms of your manufacturing. So and on top of that, a lot of onboarding of expenses are also happening. So all these new verticals, we are adding teams, we've been talking about this, and a lot of the new initiatives are actually now showing the results, and it is pretty evident if you've had the chance to look at the presentation that we have uploaded today. As you can see that our reliance on a single customer has been going down drastically. So within a year, from 52% revenue share, now it has come down to 32%, and with steady top lines. So all those, this new revenue is coming from all these new initiatives that we have taken, and profit margins or EBITDA margins, gross margins will definitely follow once we achieve certain volumes and quantities.
Because we are already starting the delivering the new products and all, so for all in these categories. So on quarter basis, you will see the improvement.
Okay. Sir, what about guidance in terms of top line?
I think Nileshji, guidance we will be able to provide probably some idea in the next quarter. We are just going through the process because a lot of initiatives are new as of now, so we are also trying to understand where this year we will be landing. But I think last year we did give an idea, so we'll stick to that as of now. But I think by the middle of the year, probably next quarter or the third quarter, next quarter we'll give you some idea regarding the guidance and the margins.
Okay, sir, my last question is regarding new verticals. This we are sure all the new verticals we entered into are maturing now, have been started, because the development time, R&D time, everything is past. Now the results will start coming.
Okay. So my last question, our one customer businesses for Philips lighting. Can we get the idea regarding other vendors or other customers in terms of our other business? Is there any customer concentration over there other than Philips?
In that sense, there is no such concentration, because then the list of customers is pretty wide when it comes to, we have multiple verticals, and within those verticals we have a huge list of customers. So, I mean, it's not even possible to, pinpoint the percentage in that sense, because the percentage, I think, of the second top most customer, I don't have the exact number right now with me, but I don't think it's even more than maybe 2% or 2.5%. So just to give you a reference, it's not the exact number that I'm pinpointing, but just to give you a reference. So that is not a concerning part going forward. And that is how we've also planned, going ahead in terms of the products and verticals, and in fact even geographies, that we want to diversify in such a way that, because this was the most questioned question during our investor meetings, and I think we are working in that direction, like we discussed during our early times of the IPO.
When we went to IPO, we were almost 75% dependent on a single customer. Now it comes to 32% within 2 years.
Okay. And these contracts are recurring in nature?
Yes.
In other business?
Absolutely.
And these are the new starters, and these will grow like anything when we are working. The whole team is working on that.
And the reason why, it takes time to reflect those in the balance sheet is because we are we are ODMs when it comes to all the categories that we are in. So it's a long process of developing a product, getting the approval, getting the certification. So there is a long list, of the developing till the time it hits the manufacturing lines. And that is where the stickiness is also there, because, it's our design, we develop for everyone. So it's not like we start manufacturing today and tomorrow the same product goes to someone else. So that is why it takes time initially, but then what the relationships that we make, they stay for, quite a long period of time.
Okay. Thank you so much. I'll again join in the queue.
Sure.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and one on their touchtone telephone. Our next question is from the line of Somnath Paul from Relay Investments. Please go ahead.
Thank you for giving me the opportunity. So, sir, I think we have been hearing this commentary from past few quarters that the contribution from the lighting business is going down. But we recently also read that Signify has tied up with one of the leading manufacturer company in Noida. I think that was Dixon. And I think so. Is it like taking away our share and going to that company? So that is one. And secondly, sir, I think in the ODM space, which is a fast-growing electronic space, so historically the products which we have done have given us good margin and a good return on capital. But I think post IPO we have not seen that, although we understand that the new factory has been commissioned. But I think the return on capital employed on the products which we are doing is pretty low. So I mean, what is like the plan for the management? Because I think the return on capital has been significantly low, although there has been a big capex. And thirdly, sir, I would like to ask that, pardon my understanding, but are we not doing significant technical products? Because I think the other ODMs in the electronic space are growing at a good CAGR with a good future visibility. So why is that the case that we are not able to miss the bus? Thank you.
Yeah, thank you, Mr. Somnath, for the question. So coming back, I think you had 2-3 questions in one. So I'll start from the first part of your question regarding Signify. So as you know, everybody knows that they've entered into a JV, and we being the ODM, so definitely we are still continuing to supply the products that we do for them, and we are also looking at this association very closely. But if you look at the silver lining of the entire procedure, whatever has happened, so that has actually opened the doors for us as well, because strategically we sort of restricted ourselves to working with them, looking at the long-term association, and we've been working for quite some time now, more than I think 13-14 years now. But that has sort of opened the gates for us as well, and we are like Mr. Hardeep mentioned there during the opening. We are working with a lot of companies now. In fact, some of them, the products have already been approved, and initial few orders have also started coming in, the trial orders, or you can say the first few orders. So that progress has already, we've covered that part of the journey till now. And so we are a well-known, name in the industry. So a lot of brands are also very happy to work with us, and likewise for us as well. So this is a new development that is happening within, the space where we are working with Signify. So we'll continue to work with them. We are now working with a lot of other brands as well. So slowly and gradually you will get to hear more names during our earnings call once, the business becomes substantial. So we'll definitely keep the investors in the loop.
Like the approval stages and onboarding stages has already passed. So I think within this end of this quarter or next quarter, all the major brands you will see that we are going to do for them.
And now coming to the second part of the question, where you were asking about, where our peers are doing some technical products. So in fact, for that matter, if you look at what we do, more than 90-95% of the products that we manufacture are all ODM products. So we design, develop, and manufacture for our customers. So in that sense, not just lighting. So if you look at our presentation today also, that will give you a much better picture of how we are growing and how we are developing. And in fact, we are now getting ready for sustainable growth in the future, with reliance on a single customer, on a single product type, or a single vertical is gradually coming down. And in fact, we are diversifying when it comes to products. So for example, the hearable and wearable category that we launched that we started less than a year back, that has become profitable. And there also we are one of the very few in the industries who've started manufacturing the actual products in India instead of just importing and assembling the products, which the rest of the industry is doing. So we are taking a lot of initiatives in these directions, but some of the things we restrict ourselves from talking about, just to make sure that, it becomes like a substantial size and where we can talk or give that confidence to our investors. Likewise, I'm talking about the hearable segment. Similarly to that, even if I'll talk of, the export business that we are doing. So again, one more vertical which we started less than a year back, which was the product display segment in the Middle East. So within 1 year, again, that has become profitable, and we are doing substantial business now in that vertical as well. So again, all the products that we do in that category, they are all ODM products, designed, developed, manufactured in-house. So everything that we do, they are all technical products. And now going forward, in fact, automotive is going to be one more segment. So I think by the next quarter, this quarter 2 or quarter 3, we'll definitely give you some very promising news when it comes to the automotive segment, which I think you will really appreciate. So there are a lot of initiatives that we have taken, which are now slowly and gradually giving results, and I'm sure before the end of this year, you will not have any such doubts when it comes to the kind of products that we do. And in fact, one major silver lining that you can take from the association that you just referred to in the first part of your question. So that was also part of our plan all along since we started our journey, because that was one of the most picked out questions, our dependence on a single customer. So in fact, with that is automatically now coming down, and we have opened our gates to all the major players in the industry. So that we look at it as a positive side, and we are working with Signify. We will continue to work with Signify, but now as a plan of our overall diversification, we continue to do that going forward. So I hope I have answered your query, Mr. Somnath.
Yeah, sir, I will get back in the queue. Thank you.
Sure.
Thank you. A general reminder to all participants, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. The next question is from the line of Pushkar Bothra from AJ Investments. Please go ahead.
Hello.
Yes.
Yeah, am I audible? Yeah. Thank you for the opportunity, sir. So I wanted to talk about, ask a question about the other business segment, which has grown pretty well in the last 5 quarters, from 48 to 68%. So if you can break down the growth, how it has been, and what will be the strategy going forward, how much percentage of the number it will look like going forward?
So as you can see from the presentation, close to around our share of the business outside of India has been growing constantly, and that is one strategy of diversifying geographically. That is playing out really well now. So we are focused on outside of India, and as well as the new setup that we have created, because of which the numbers temporarily seem low in terms of the margins, the EBITDA margins, because of depreciation, as PAT margins because of depreciations and everything kicking in. So right now, the new growth, that is going to come from the markets outside of India, as well as the new verticals, and which we are at a juncture where we are now starting some sample ordering, prototyping. In fact, small shipments have also started from the new plant. So I think it's just a matter of another couple of quarters where the new plant revenue from the new plant will also start kicking in, and will substantially improve the top and the bottom line going forward.
Understood. And so, as you mentioned, as your growth strategy would be expanding into the new countries, but in presentation I saw 2 names. One is USA and another one is Middle East. So recently, what tariffs has come out. So what impact are we expecting because of that? Because in the same presentation you have also mentioned good traction we are getting in US as well.
Yeah, so actually it's too early to talk about that, as I mean, I'm sure you must be following how things are, panning out. So today it is something and tomorrow it is something else. So last few months have been a little too crazy, I would say. So I think we are just waiting for things to settle down so that we can make sense of what is happening around us. And for that part also, because we are competing, primarily with China when it comes to the US market. So the belief is that our tariffs are always going to be lower as compared to, the tariffs on the Chinese products. So that is one comforting factor. But at the same time, to truly answer your question, I think we'll have to wait a bit more to understand how this entire thing is going to pan out.
This is USA is one of the segments, but here, like, we are entering into the new, already developed the product, and the sampling stage is on for automobile lighting, automobile electronics, then building safety systems, which we are working with brand like Honeywell. So these are all all the certification, samples, approvals, everything done, and we have already started getting the orders for those as well. So it is not only we are dependent on USA or say, it is a multiple.
Right. And also, how much was the revenue bifurcation between US and Middle East, if you can number something?
So, just to give you an idea, it was close to around, in percentage terms, I can say USA was around maybe 60 to 65%, 65%, and remaining was from the Middle East. But Middle East, because USA is our, I can say around six-year-old market, although the subsidiary that we opened up in the US was just last year. But UAE is a pretty new market, which we just, started the business and everything last year, so it's progressing really well. For that matter, to have a contribution of, let's say, around even 30-35%. But this contribution will also continue to grow from the Middle East as well.
So, the number at roughly 18 to 20 crores was from USA, right? As per what numbers have given?
Approximately. I don't have the exact numbers right now in front of me.
Yeah, I just back calculated, as you mentioned.
Yeah, I know. So I was doing the same in my mind, so roughly around that figure.
Okay. And I had also one more question on the new segments which you are entering into wearables and wearables category. So how has been the performance there? And what are we expecting going forward? Because there's also a lot of competition from China. A lot of players are doing here in India.
Yes, for that also, what we are doing, we are just started the relationship with all 4 or 5 big companies which are in this segment. We have started with everyone. Everyone is we are entered what were they doing. So this is the first month where we are going to produce first made in India product for them. We will happy to announce that we are the first one to get the order of say 50,000 pieces of that, which we have developed in-house. So similarly, we have the pipeline to develop those products in our infrastructure. So this is the strategy what we have taken. So we will not see competition because we are not importing the boxes or the CKDs or SKDs in longer term, like we have done in the lighting.
And just to give you an idea of how that vertical is progressing, the existing quarter, I think we should be touching a double-digit top line or top number, I would say, revenue, double-digit. So without giving out too much, I think this will give you just an idea of how this is.
Right. No, got a fair idea. One last question. As you mentioned that for USA, we'll be competing against China. But if you can give me a pricing difference, supposedly if you are manufacturing at 100 rupees, China is doing at 60 rupees. So how is the calculation over there?
Yeah. So before Hardeep sir answers this question, just one thing I want to add to this is that we are not competing on a product to product level when it comes to what we are doing in the US. It's more of some part of it is definitely product, but it's more like a solution that we work on. So whether it's the RV industry, we are not working on a specific product, it's a solution. It's a package that we give, which constitutes of a lot of products, lighting, non-lighting, solar, charge controllers, batteries, a lot of things put together. So it's more of a solution. And when it comes to pricing, I think Hardeep sir will take that part of the question.
So costing in China is also increasing because of labor cost and other things. It is not easy. So we were competitive before also. So there is no way that we are less competitive than China also. And because we are producing everything here, so we are not dependent on the Chinese products. So all the designs, everything, molds, everything we have done in-house, so it is not affecting us much.
Okay. Thank you so much for the answers. They were pretty helpful. Thank you.
Thank you, Mr. Pushkar. Thank you.
Yeah.
Thank you. May I request and remind to all participants, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Our next follow-up question is from the line of Somnath Paul from Relay Investment. Please go ahead.
Thank you for giving me an opportunity again. So, sir, I think like we have seen in the historical numbers, I think the general EBITDA was on a higher double-digit side. But now, as you have mentioned that you are moving into a lot of new products. So, generally, what is the target return on capital employed for the capex that you have incurred for the last 2 years or so? And secondly, sir, I think mentioning about the hearing electronics and the products which you are making, and other than that, so do you think that there would also be a certain level of scalability in the products at certain point of time where we will be able to have the margin, because generally this is not a very high EBITDA margin kind of thing. So what is your general thought maybe for the next 3 years starting 2025? So if you can throw some light there, sir.
So yeah, I'll answer with the second part of your question. So basically in the wearable segment, definitely like you said, the higher the volumes, the better the margins become, because in order to run the show, your fixed cost will remain the same, but as and when the volumes start kicking in or the volumes become substantially high, your operating expenses come down, and that is what our target is, and in fact this market is also all about. But the good thing is that we are already working with all top brands, I would say, all top companies who are into this segment, and we have already started working with them. And going forward, the plan is to make everything in-house, like we did with the lighting category. In fact, as a matter of fact, like I said, it's just an year-old vertical. But even just after an year, the space that we had dedicated to this vertical is already short. So we are adding more space, or allocating more space to this vertical going forward. In fact, by the next or second or the third quarter, we were just discussing internally also, we'll start showing the results in slightly different manner, so that it becomes easier for the investors also to understand how the other verticals are also performing. Because up until at the time of the IPO and the beginning of the IPO, we were majorly a lighting company, although we were doing a lot of other electronics also. But yeah, at the face of it, we were majorly a lighting company. But things have been changing drastically, and we'll also present our business in such a way so that it becomes easier for everyone to understand. And I think by another couple of quarters, our new verticals will become substantial enough for us to present them in such a way that you will get to understand where exactly the business is moving ahead. And I'm sorry, I think I missed the first part of your question. If you could repeat that.
Sir, I think that was again along the same lines. I understand that this is more like a volume game, and this has been more or less done to absorb the fixed cost of the new space which you have commissioned, which is very understandable. But my point was on the return on capital, sir. What is your general return on capital? Because you mentioned names that you are targeting in terms of customer, but your competitors were much larger in size, say the Dixons or Amber, so I think they have scaled up pretty well. So, I mean, I'm just trying to understand on the return on capital part. So the amount you've invested and when do you think will be the payback, including the variable plus the other higher margin products?
Yeah. So if you look at the ROCE, maybe 1.5 year earlier, then we were somewhere close to sitting somewhere, from what I remember, I don't have the numbers right now, but from
So those were numbers of fully sweated assets, right? So those assets were created long back and those were highly depreciated. So obviously that number will be optical. So I'm trying to understand from next 2-3 years point of view, because now we are putting in the money for the last 2 years and we are still doing. So I'm looking further into future, because those numbers look optical in the sense they were very high numbers and the margins were also very good because you had very highly sweated assets and the throughput was also high. But I'm talking about now and way forward.
So at that point in time, from what I remember, it was, I think the ROC was anywhere between 30 to 32%. And like you said, everything was, the assets and everything were almost fully utilized. But to reach to that level once again, we believe that the way we are working, by the end of next financial year, we should be closer to that or comparable to that value. I think by the end of the next financial year. But we'll have to make some calculations. This is just a rough estimate that I am giving out.
Sir, also wanted to ask that in 2020s, your sales were closer to the 200 CR kind of number. So do you think in the next forthcoming time that sales number could probably be your EBITDA if you have a good run rate? So, on a longer term trajectory, can you share some thought over that?
So basically, what you said is correct. That is what the target is. And moving forward, we are just waiting for all these new relationships to come out to that level where the revenues from each one new product category or account becomes substantial. So it's just a matter of time of how these things progress. But the good part is, whatever initiatives that we have taken in the past 1 year, we have not gone back on any one of them. So everything that we have started is moving in the right direction. It is just that, like I said earlier also in the call, because we design, develop everything in-house, so that, for each product, it's a time of about anywhere between 3 to 6 months to 9 months, depending upon the complexity of the product. So that time plus the certifications, approval, so that's a very long journey that we have to travel for one product to begin with. It's not that the relationships that we have, they share the design with us and we start manufacturing the next day. Our way of working is completely different to some of our peers in the industry. And that is why, hence, it's taking a lot of time for us as well. But at the same time, like I said, once you've crossed that bridge, which we are in the process as of now, then it's just a matter of ramping up the volumes and the numbers. So what I can say is that by the end of the third quarter this year, you will start actually seeing what I am saying right now in my answer.
Okay, sir. I think we will wait for that. And I wish you to probably more focus on the return on capital part, because that I think will help us get the valuations which we should get. All the best, sir.
Absolutely. Our FA has always been around 5 times and, 5.5 times historically. That is what our target is. It's just a matter of, the time that it takes for all these things to mature. And, in fact, the plan is to return to that level as early as possible.
Because this is the time of ODM electronics, and I think you are on the bus. So I just wish and
we cannot tell anything futuristic here, but we are very positive because whosoever visited our plant, it is means we have a very good appreciation for our plant system or whatever infra we have put during this 1.5 year. So it is it is state of art, and I will tell our seller people to get some visit, plan some visit that where we are, and we can show that what we have done new, and those things we can see through them also.
So once you visit the plant, you see where we are today, what we have developed, you will automatically get the confidence of where we are headed in the near future.
Yeah, and I think this company will from scratch, so I'm all the more positive, and I wish all the best, and hence I'm more concerned that probably we should have a good, fruitful journey for everybody. Hardeep sir, thank you.
Thank you so much, Mr. Somnath. Thank you.
Thank you. A reminder to all participants: anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Our next follow-up question is from the line of Nilesh Sharma from Anantnath Skyken Private Limited. Please go ahead.
Sir, my question is regarding our corporate decision that we have taken this week. Could you share the rationale behind appointing a family member as a CFO, and how the company ensures the strong governance and independence in the financial decision making, and how our financial decision will impact our company future by adopting this decision that Sanjeev Singh will be our new CFO?
Thank you, Mr. Nilesh, for asking the question. So I'll be more than happy to answer it. So as you must be aware that our CFO recently resigned. So we are actively working to identify a suitable replacement, over the next 2 to 3 quarters, because this is a very important position in the company. While there are no statutory restrictions, if the CEO becomes the CFO, but like you said, we are fully committed to maintaining strong corporate governance. And given my involvement in overseeing the finance function over the past 2 years, I have taken this responsibility to ensure continuity. However, we remain focused on appointing a dedicated CFO within the stated time frame, which like maybe next 2 to 3 quarters.
Okay. And so my question that we were earning 21 crores of PAT in 2020, and after the growth of 2.5 times in top line, still we are earning 22 crores. Being a shareholder of the company, we have the great belief in management and the product and the setup that you have done in last 1.5 years. How we can see this picture? Because at various point of time we have requested Stellar to schedule a plant visit, but we are unable to get any mail from investor relationship manager. So we didn't get any idea what is going on there. Please excuse me if you get offended by this question.
No, not at all. You have all the rights to ask anything that you feel of concern, and I'll again be happy to answer or take up this part as well. So like you mentioned, in 2020, the PAT was, like you said, around 20 crores. So if you look at the PAT which we made last year, which was 32, but if you look at the cash PAT, so in cash PAT we are just adding the depreciation of the the new plant, not anything to do with the old plants. So that was close to around 56 crores. So basically 20 can be comparable to 56 of last year, and at the same time this 56 was also under a lot of, I would say, a lot of stress from the the operating expenses and everything that we have sort of incurred, which the results will start coming in later. So the employee cost went up and the operational expenses went up. So this is part of the journey when you try to sort of break the shackles of where you are, and in order to move from one level to another, there is always a transition phase. So we are just going through that transition phase right now, but I would say the silver lining or the good part with all of this is that we are still operating revenue. We are still making revenue or PAT, and in terms of operations also, I think we are progressing really well. It's just a matter of this transition that is happening, and I think next year I'm sure you will not have any such doubt with the way the company is performing, and you will start to see that from probably quarter 3 of this year, that transition.
I wish the same, sir. Sir, as you have given the guidance of 30% ROC at the end of financial year 27, can you please give some lower guidance?
That is not a guidance from my side. It was just I was referring to where we were earlier and where we want to, because honestly, I don't have any calculations right now in front of me, but just to give you an idea, we were close to around 30. So like I said, by the end of the next financial year, I believe we should be somewhere comparable to where we were at that point in time.
Okay. Any idea where we are closing our financial 26 books in terms of ROC? Any idea?
Honestly, I'll come back to you on that. We'll make some through Stellar. Maybe we'll get back to you on the ROCE part, because we need to make some calculations. I don't have it right now in front of me, but we'll definitely get back to you on that.
Okay, no issues, sir, and thank you so much for giving all the answers, and I wish you all the very best to company and all management.
Thank you so much, Mr. Nilesh. Thank you.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, as there are no further questions, I now hand the conference over to Mr. Hardeep Singh for closing comments. Over to you, sir.
Thank you all for making it to our quarterly earnings call for Q1 FY26. If still there are any further queries, please feel free to reach out to Stellar IR advisors. And again, I thank you everyone for joining the earnings call. And have a nice day. Thank you very much.
Thank you so much.
Thank you.
Thank you. On behalf of IKIO Technologies Limited, that concludes this conference. Thank you for joining us, and you may now disconnect.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.